Have you ever felt like your emotions are getting the best of you while trading? For example, you feel like everything is in the right place, you've done your back testing, you've got a strategy, you go to live market, you put in real money, and that's where it all changes. It feels like things start crumbling. You stressed, you are unsure about trades that you used to be sure about. You are anxious to take trades. You are worried that you're going to miss trades. You know, all these emotions just bubbling inside you and just, you know, getting to a point where you kind of want to back away a little bit, take a step back, take a rest. You are not alone when it comes to this, guys. Definitely not alone. In fact, I think you're probably one of the majority. This is probably one of the biggest causes that traders do not find success. Psychology is one of the main pillars when it comes to trading, guys. And if your psychology is not in place, it's going to be very difficult. No matter what, you can have the best strategy in the world. But if you are not prepared mentally for that strategy, if your head's not in a place that it should be psychologically, then you're going to find it very difficult. And there's a lot of factors that come into play, a lot of factors. In fact, this is a video that I could probably talk on for hours and hours and hours, but that's, you know, obviously I'm not going to do that today. Instead, what I'm going to do today is I'm going to give 5 practical tips to help improve your trading psychology. So I'm going to just touch on 5 things that I think can go a long way in helping your psychology. Now, obviously, like I said, there is so many different factors that can affect traders, and every trader could be different when it comes to psychology. But these 5 things, I think, are things that everyone can do and can start working on to overall improve their psychology as a trader, which in turn can make you a better trader and hopefully a more confident and profitable trader. So let's go straight in, guys. I don't want to waste time. I just want to go straight in and just talk about these things, and you know, let's get on with it. So the first one I'm going to be talking about is risk management, or what I like to call the safety net of trading. Now, risk management is not the same thing. It is similar, but not the same thing as trade management. So I am actually going to be speaking about that later as well. So make sure you stick around for that, because that's also very important. So risk management is more talking about your initial investment, for example. So not only your initial investment, how much money you're putting forward, how much you're investing, but also your risk per trade. So it's not only your overall investment, but it's your investment per trade as well. So the concept behind this is, what are you willing to lose? And I think this is the most important question you can ask yourself when you are stepping into the trading arena. When you've got to a point where you say, okay, I'm going to now trade for real. I'm going to put money down on the table and I'm going to do this. You've got to ask yourself, not how much can I make? And I think that's the mistake a lot of people do make, is they come into the market, they come into trading, they see a lot of things online, they see people, you know, getting rich quickly, supposedly driving around in fancy cars, living the high life, and they want a piece of that, which, you know, I don't blame them. I don't blame you if that's what you want. That's kind of what attracted me to it in the first place. You know, I think you've got to be realistic, and you've got to look at trading from a longer term perspective. You can't look at it like, I'm going to get rich in a couple months, you know, because at the end of the day, each person is different and your risk will be different. So you've got to ask yourself, what are you willing to lose? So if you have, for example, let's say you've saved up for the last 10 years and you have like a little safety net of savings of about, let's say, $60,000-$70,000. You're not going to throw in 50 or 60,000 of that, because that's literally everything. You know, if you lose that, you've got to ask yourself, if you lose what you initially invest, is that going to hurt you? Can you come back from that? So if the answer is no, then that is too much. You've got to start slow. And especially if you're very new to trading, you've got to be very, very careful about how much you initially invest. That's why a lot of people will always suggest you start with a demo account, even though that is not real money. So the emotions are slightly different, and trading with a demo account gives you an idea of how live markets move and how your strategy might work in real time. But it's not going to make you understand how you will feel when a position that has real money on it starts moving against you and you're watching the red numbers get bigger and bigger. No one can prepare you for that. You have to jump into that and do that yourself. And when you place your first trade and you see that, you know, for most people, they stress out when they see that. So the point of what you're willing to lose is making sure that whatever you've invested, it's not going to stress you out for every trade you take. If you're going into a trade and every time you put money into a trade it stresses you out to no end, then your amount is too high. You've got to try and get to a point where you can throw in whatever your risk per trade is and accept that, right? Now, that is obviously what we're talking about from a bigger picture in terms of what you're putting into your live account, your personal account. But then we've also got to talk about your risk per trade. So this is something that obviously ties in, and everything I speak about today is going to tie in. They're pretty much going to working together or overlapping. So for this, for example, your how much you're risking per trade, that also goes into your strategy and your back testing, and all of these things have to work together. But you know, make sure that you're always risking the same amount, or whatever you've back tested for, or whatever your plan is, or whatever your strategy is. Make sure your risk is sticking to that. That's basically it, guys. What is the psychological benefit to understanding your initial risk? By having a robust risk management strategy, you reduce anxiety and fear. You will trade with confidence that win or lose, you're okay with the outcome. And that's the important thing, guys, is that you've got to be able to go into a trade and be okay with the win or the lose. Obviously, I'm talking about going into, you know your strategy. I'm just talking about the money side, guys. If you lose, it's okay, because let's say you have a strategy that has a 55% win rate. That means 45% of the times you're going to be losing, and you know that, right? So be prepared, and the less anxious you are when you are taking trades, the less likeliness there is of you making stupid decisions, interfering where you shouldn't. Okay, so just ask yourself always, guys, what are you willing to lose? Okay, are you willing to lose what you put in? Or if you lose that, is it going to really set you back? And you've got to think about that. So I would initially start very small, start with an amount that you are okay to lose with. So let's say, for example, $10,000 is a lot, but you can afford to lose that. But even that you're like a little bit worried about, then go to like 1,000. Just put a tiny portion of that in, put 1,000 in, trade with that, trade with real money to get an idea of how you are going to react to loss. And if it affects you on that amount, then you've got to reassess how much you're putting in. Okay, so very important, guys. Risk management is an extremely important part of your psychology, and just getting it right and understanding your loss and your win. So with that being said, let's go on to number 2, guys, and that is daily routine. Okay, consistency is key. Now for me, I like to every day come to the chart just before I'm going to trade. I'm quite a time-based trader, so depending on your strategy, you know, you've got to just know when you're going to trade. If you trade based on setups, and that could be anytime, that's fine. But I would try and set up a routine that every day, you know, you get your cup of coffee, you get your tea, whatever it is you have, you settle down. And I like to personally sit down and have a look at the charts. So the charts that I know I'm going to trade, for me, I'm pretty much trading 1 or 2 pairs max. Even though I've traded the day before and I know the general outlay or bias of the current market, I will still, for example, if it's beginning of the week, I'll probably go to a daily and have a look at where we are. If it's midweek, I'll probably just go to like a 4-hour, because I normally will trade on, I'll find my setup on the 5-minute and then I'll trade on the 1-minute. So I'm quite low time frames, but I like to get a general feel of where we are in the market. So I kind of am prepared for what the market might do, okay? Like, no one can predict what's going to happen, no one, because otherwise, you know, we would be 100% traders. But we can, if we have an idea of what the market might do, it's not going to surprise us. You know, we've got to try and keep that element of surprise to a minimum. Then the other thing I like to do is I like to always then, after I've kind of done my analysis, I will go to the news. I'll have a look at what news we have coming in for the day, and I'll kind of prepare myself that way. So if I am going to be trading at a set time and I know I'm trading that, and I see that there's actually big news right around the same sort of time that I trade, I know I'm gonna still look at the markets. I'll still follow the charts, but I'm gonna be very, very wary of the fact that there is news. I am prepared for it, right? Prepare yourself for the day ahead. And I think just having a routine every day, whatever it is, whatever your routine is, I'm not telling you to do exactly the same thing I do. I'm saying find a routine that works for you. If it's, you know, doing some yoga before you step to the charts, fine, do that if that makes you feel good. If it's having a run in the morning, and these are things that you can do outside of the charts as well that kind of tie in to how you feel when you're sitting at the chart. You know, if having a run in the morning gets you up and gets you fresh and makes you feel good for the day, that's good, right? Because if you feel good in front of the charts, the more fresh and the freer your mind is, the better it is going to be in terms of a trading day. So prepare yourself for the day ahead, whatever it is. Just try and find a routine that you stick to. And routine can also be things like journaling. Make sure at the end of the day you end with reflection, for example. So beginning of the day is routine, but also during and end, right? So like end with reflection, for example. Review your day, review what has happened in the day, journal it. And now I like to journal during as well as after. So during my trades, I like to just jot down my emotions, talk about how I'm feeling when I'm watching the chart. Most of the time it's kind of, you know, the markets are doing what I was expecting them to do. My trade is playing out as expected. Even if I lose, I feel like sometimes I was kind of expecting it because I feel like I might have been trading, and that's good, right? I'm learning with my losses. And then reflect, learn from whatever's happened during the day. So take your day's routine, take whatever's happened in the day and use it to kind of power you to the next day, right? Understand, learn, and just move on to the next day so that you are ready and fresh for the next day, and have an understanding of whatever happened that day happened it. Have an understanding of why whatever happened that day happened. You understand why, okay? So very important when it comes to your psychology, guys, staying on top of everything and sticking to some kind of routine. What's the psychological benefits to this? A consistent routine sets the tone for a disciplined trading day. It keeps emotions in check and ensures you're always prepared for the market's challenges. It's not saying that you know what's coming, you're prepared, okay? Preparation is key, guys. Make sure you're prepared for what might happen. And there is going to be times that things happen in the market that we have no preparation for, but you know, that comes down to trade management and risk management as well. If those are in place, then we are kind of in some way prepared as well. So that's the second part, guys. Number 3, trading rules, okay? Your personal trading constitution. Now this obviously ties in with strategy and plan, your trading plan and your trading strategy, okay? You've got to set yourself very clear criteria, right? The rules make the strategy, okay? So I always try to, when I'm setting up a strategy, whatever it is, if I found the strategy online, for example, and there's a set of rules, but I find that the rules are a little bit subjective, then I will kind of backtest and tweak to the point that I can make the rules very, very, very basic to follow. The more simple my rules are, the better I feel like I can trade it. Because I like to, you know, have rules that it's like step 1 done, step 2, 3 do, and then trade. I'm in the position, and I know I'm in the position based on my rules. So no matter what happens, I feel okay because win or lose, I followed my rules. And based on my back test, these rules have a set data that I'm very confident with. I know that these rules and this strategy have, for example, a 65% win rate when I'm taking a 1 to 1.5 risk reward. So having the very clear rules I think is very important, guys. So don't have very obscure rules, or have things that, like, you know, if this or maybe or this could happen, or if that happen, you know, try and keep it as clean and as clear as possible, guys. I think it's extremely important when it comes to trading for real, when you're actually in a live market. Those rules really will make the difference. And then obviously stick to the plan. Once you've got your strategy, once you've got your rules in place, and once you've backtested that and you have your data based on that, you have to stick to the rules, because the second you deviate from those established rules, you are essentially completely throwing away that data set. All the data you've collected, and sometimes it can take a long time to get data, it's for nothing. It's for nothing if you are not sticking to the plan, guys. And if you choose to change something, you have to go back. You have to go back to the back testing. Test another 100, 200, 500 trades again with the new change. And only then is your data ready to go. Okay, so guys, have very basic rules, have very easy to follow rules, but then stick to them. Extremely important, guys. What's the psychological benefit to this tip? Trading rules act as your anchor, preventing you from making impulsive decisions based on greed or fear. They instill a sense of discipline and purpose in every trade. So very important, guys. It helps you just stay on track, and it helps your emotions stay in check even when you take the losses, because you know you followed your plan, you did what you were supposed to, you didn't do anything wrong. Okay, so it makes it a lot easier to take those losses, because it's just part of your data. Data says I am going to take losses, so you've got to then accept that. If you're sticking to the rules and you've done everything you should, that's fine. Move on to the next trade. All right, number 4, guys, is obviously back testing. Now, I've talked about this already, because I've told you all of these things in some way will intertwine with each other. Back testing is confidence through history. Back testing, you know me, guys, if you've seen any of my videos, you know how much I love to back test. Review past setups. Analyze both successful and unsuccessful trades. Okay, backtesting is such a big part of trading and trading psychology, because once you've got your rules and they are set in place, you will then go to the market and backtest. Backtest as far as you can, get as much data. The more data you get, the better it is. Okay, backtesting, it really will help your psychology, because not only are you getting data, but you're literally taking every setup based on your rules. So every setup that plays out in past data, you're seeing it, you're understanding, you're seeing how the market moves. So when you trade in live market and market does something, again, it's not going to surprise us. We're not going to be shocked, because we're going to feel like, oh, I've seen this before. I remember when I was backtesting, I remember when market did something like this. So you understand that this is just part of the game. It's how markets move. And maybe sometimes in the future, you could even avoid certain trades, because you understand, okay, when market does this, I actually want to stay out. So backtesting gives you an understanding of your strategy, right? It makes you understand your strategy to a point that you gain more confidence. And confidence is extremely important when it comes to trading, guys. You want to go into every trade with a set amount of confidence. If you're unsure when entering a trade, you're kind of already on the wrong foot. Okay, you want to start on your strong foot. Go into a trade with full confidence, because you know you've tested it, you've stuck to your rules, and whatever happens, it's okay. All right, the next one is refining your strategy, right? So use this historical data to tweak and improve. And what that means is kind of what I talked about in the previous one as well, is as you're backtesting, if you're seeing the numbers are okay, but you feel like they could be better, tweak, change, Do whatever you need to do. That's the point of this whole process, right? Change your risk reward, maybe, for example. Change small things that are part of your strategy. But let's say, for example, you've done your full test, right? And you see at the end of it, you've done 100 trades and your results tell you that you've got a 55% win rate. That's okay, but you're not quite happy enough with that, right? And then you think, okay, but what if I just change one of my entry criteria or how I take my profit, for example? What if that improves my thing? Okay, let me just test it. And you test it on like 10 trades, quickly testing it just to see, you know, is there something there? And then you see, okay, hold on, this is actually showing in the last 10 trades, I won 8. So I've, you know, suddenly got an 80%. Don't just take that small data set and then say, okay, I'm running with that. You've got to go back and unfortunately it takes time, but you know, it'll be worth it in the end. Back test the new changes the same amount that you did the last. So if 100 trades is your back test amount, 500, whatever it is, trade it again, get a bigger data set, and that'll give you a clearer win rate. Okay, it'll give you a better understanding of what that win rate is. And again, you're going to see all the trades play out. So very, very important, guys, that you refine your strategy if needed, but back test it. So what are the psychological benefits to this? Back testing offers reassurance. By understanding your strategy's past performance, you trade with confidence that you're following a tried and tested path, okay? And that word comes up again and again and again, guys, because it's so important to trade with confidence. If you're going into the market with confidence, win or lose, it's a magical thing. It really, really is. All right, guys, let's move on to the fifth and final tip or topic that I'm going to be talking about today, and that is trade management. Leave it or watch it, okay? So trade management is different to risk management in the sense that trade management is more, once you've selected how much you're risking per trade, you are in the trade, it's how you choose to manage that trade, okay? Because some people, the real anxiety kicks in after they've hit the buy or sell, okay? So if you can manage it in a way that reduces your stress, then do that. Some people like to just leave it alone. So what's your sweet spot? How much are you going to manage your trade? Are you going to, for example, let's say your risk to reward is 3-1, right? And you don't touch it. You back test that and it gives you a 45% win rate. On a 1-3 is still very good. You're still going to be profitable. Are you the type of trader that can deal with 55% of your trades losing? Because what will happen is a lot of traders will understand that. They'll look at the data and they'll be like, that's cool. It's fine. And then they'll go to live market and they will take loss after loss after loss, which is part of the strategy. You know, let's say you're going to be taking 5, maybe 6 losses in a row sometimes, and they just start crumbling. They cannot handle the losses. You get some people that just cannot handle the losses, even if it's a part of their strategy. Then you've got to rethink your management. If you can't handle losing, you've got to reevaluate how you manage it. So then, for example, if it's a trader that cannot handle the losses but still likes the strategy, likes the 1-3, what they could do is they could say, okay, when my trade gets to a 1-1, I'm going to take 50 or 60% off the trade, and then they can decide to move their stop to where entry was, or they can leave their stop alone. Because essentially, if you're taking 50% off the position when it moves to 1-1, and then it moves down to the stop and you don't touch the stop, essentially it's risk-free still, because even if you lose the 0.5, you've gained 0.5. So essentially you'll just be paying for commissions or whatever it is. So maybe you'll make a small loss, but if you're taking 60%, then, you know, the trade will be kind of break even. You won't make anything, but you won't lose anything. So it'll be a draw. So you've got to decide what works for you. And it's extremely, extremely important, guys, because when you're in the trade, like I said, that's when the stress can really, really affect us, right? Now, whatever your trade management is, make sure you stick to it. Again, this is kind of part of your strategy, how you manage a trade is essentially also part of your strategy. So you should have back tested that, okay? But for me, for example, I understand risk reward. I understand everything. And I know that certain strategies will have a lower win rate if they've got a higher reward rate. But generally, I'm just someone that doesn't like to see loss after loss. So I would rather see, you know, more draws or more kind of break-even trades than I would like to see losses. And you'd probably find the interesting thing is, let's say after a few months of trading, the exact same strategy, you have trader A who is taking a 1 to 3 risk reward, and he essentially will set and forget. He will not touch his trade, which is management. Even though you're not touching it, I know you're not physically managing it, but that's your form of management. Your management is to not touch it. So trader 1 does not touch it. Trader 2 lets it go to 1 to 1, and then he will take 50% of the position and, let's say, move his stop to break even, for example, or leave the stop. However he wants to play it. After 3 or 4 months, you'll probably find that trader 1 is still more profitable, because even though their losses are more, how much they're actually taking when they win is way, way bigger, okay? But if trader 1 can handle that, that's fine. Because trader B, at the end of the day, he might not be making as much, but he's really chill, he's confident in his trades, and he's making money. So it doesn't matter, guys. And that's why sometimes you shouldn't really watch too much in terms of other people's setups and what they're winning and what they are making, because most of the time they are only going to be telling you what they are making. They won't be telling you what you're losing. And you kind of get that competitive thing that you want to make that, and you feel like, oh, you know, I feel like I'm not making as much as this guy. It's not a competition. At the end of the day, guys, you're winning if you're not losing. That's all that matters. Just make sure you're beating the market. That's all. The only thing you have to stay ahead of and beat is the market. Don't let the market beat you. It doesn't matter if anyone else is beating you. That's their deal. That's what they do. Just concentrate on you. You are the one that is in charge of your future, okay? So don't worry about what the person next to you or someone on Twitter is saying or whatever it is. Just make sure you have put all of this in place and you are doing your thing. So the psychological benefits to this one, guys: effective trade management ensures you're always in control. Figure out what works best for you and stick to it. Very important, guys, and that's kind of repetitive as well in the things I've said today, is stick to it. Once you've got something that works, stick to it, okay? Very, very important. So that's it, guys. That's the 5 things I wanted to talk about. They were pointers, and they were also tips in their own right, because I was telling you how you should be using these in your trading days. So trading is as much a mental game as it is a strategic one. By mastering your trading psychology with these 5 tips, you're setting yourself up for not just financial success, but emotional well-being in the trading world. And emotional well-being is so important, guys. It's so important to make sure that your mindset and you are in a good place when you're trading, because if you're not, it's going to make it very difficult to trade with that confidence. And sometimes it's okay to step away from trading, because, you know, sometimes things happen in life, and no matter what your strategy, whatever strategy you're using, if you're mentally struggling, you know, for example, for me, I recently lost someone and I stepped away from trading for a while because my head was not really in the game. You know, I saw the setup, but even if I took a loss, knowing that I'd followed everything and I'd stuck to the plan, it would probably hit me harder at that point just because of where my head was at. So I did take a step back, and, you know, I'm glad I did, because I think it would have been very difficult to trade for a couple of weeks at that point. So sometimes it's also good to just, you know, whatever's happening in life, guys, let that dictate as well. If you know, there's times that you need to just step away. It's okay, you know, it's okay. Your account will still be there. And I think the important thing is maintaining your balance, keeping your account there is good. As long as you're not losing, it doesn't matter, right? It's okay to stay where you are. No one's going to take it. So just, you know, if you need to take a break, take a break. All right, guys. So that's it. If you did find these insights valuable, give this video a thumbs up and share it with fellow traders. And please hit that subscribe button so that you see when we post any more videos like this. We have a lot of videos to do with trading strategies, and I've already posted a lot of videos about strategies, and there's a lot still to come. And I will be taking some challenges in the future with strategies that I've basically given you guys, I've brought to you guys. So I'm not just bringing stuff to you, I'm actually going to be trading them as well. So make sure you stick around for that, because that I think is going to be a very interesting series where we actually start trading with some of the strategies we've been talking about. And that's it, guys. I hope this was helpful. I hope you guys take this advice, work on these 5 things, and I guarantee you trading will become more enjoyable. And I think if you can get your psychology in check, then everything else will follow, right? Because don't trade if you're not enjoying it. Don't trade if it's stressing you out. Don't trade if you are anxious beyond belief. Trade when you're confident. Trade when you feel good, okay? And trade when the losses don't hurt you. If you're trading and you take losses and it doesn't hurt you, you know you're on the right track. Okay, guys. I'm just going to basically leave you guys with a quote from George Soros that goes like this. It's not whether you're right or wrong that's important. It's how much money you make when you're right and how much you lose when you're wrong. Happy trading. Bye for now.